Okay, this is chapter 2, which is a critical chapter. This is where we learn how to actually record transactions in a way that they can be later summarized into financial statements and used by the people who make decisions. So what we do as accountants, we have to identify the transactions. So we take the source documents, whatever those might be, an invoice that comes in, an invoice that we send, a delivery ticket, a credit card bill, any kind of thing, any kind of source document. And sometimes those source documents are digital. We analyze the transaction using the accounting equation. And this is the accounting equation: assets equals liabilities plus equity. And then we record the transaction in something called a journal. A journal, you'll be using the general journal this semester a lot, but there are other journals, some special journals that may be for recording sales or recording payroll transactions. So you have special journals to make that easier. And then we post the information from the journals to the ledger. We post them to the ledger account. Then we can use the ledger accounts to create what's called a trial balance, which just checks to make sure we've got everything in balance. It doesn't mean that everything is correct, but if it's not correct, if it's not in balance, we know it's not correct. And then once we get the trial balance in shape, we make financial statements. So I want you to pay attention to this for just a second. You see the equal sign? Assets are on the left, liability and equity accounts are on the right. When you look at an account, they often are shown or described or presented in a way called a T account. Let me show you one. All right, here's a T account. It has the account name at the top, and it has a left side and a right side. The left side, for accounting, we call it the debit side, and the right side we call the credit side. So remember, left, right, debit, credit. Debit on the left, credit on the right. So remembering, debit on the left, credit on the right, the balance of an asset account will be on the left because it's on the left of the equal sign. The assets, the balance for the asset accounts will always be on the left. The balance for liability accounts will always be on the right. Accounts payable, notes payable, any accrued liabilities, any unearned revenue we talked about in class. So any of the liability accounts will be on the right. Equity accounts will also be on the right with a couple of exceptions. Dividends and expenses will have a balance on the left side because they reduce the equity section of the balance sheet. Anytime you get more or pay more dividends or incur more expenses, the balance in these accounts will go up on the left side, not on the right side. Common stock and revenues will be on the left. Will be on the right. Common stock and revenues will be on the right. All the liability accounts will be on the right. All the asset accounts will be on the left. So the balance of those accounts will be on those sides. Quickly back over to the T account, if I can get it to happen. There we go. So what we'll do is we'll record transactions on the left and the right of the account, and that will determine what the balance of the account is. What you'll do is you'll add up all the transactions on the left side and add up all the transactions on the right side, and the difference, whichever side has more money, we'll subtract them, and whichever side has more on it, that'll be the side the balance is on. Assets will always have a balance on the left, liabilities always on the right, and revenues and common stock will always be on the right. Dividends and expenses will be on the left over here, but will be on the left side, even though they're on the right side of the equation. But we'll talk about that more in just a minute. Go back to this page real quickly. Pay attention to these and think as we're going. Asset accounts. Cash is going to be on the left. It's an asset. So any decreases and increases in cash are going to be in the cash account, a T account, think of it. Accounts receivable, money people owe me, will also be on the left. Real quick note here, accounts receivable is what's called often a control account. And they put the control account has these subsidiary accounts below it, these individual accounts that make it up. For example, if I have 100 people that owe me money, I'd have one number in accounts receivable, say it's $10,000. That $10,000 would be made up of 100 different small little accounts, and each one of those would relate to a certain customer who owes me money. Notes receivable, also an asset account. Prepaid accounts, this is prepaid. They call them prepaid expenses. I like to call them prepaid assets, but in this book, prepaid expenses. And you think of those as prepaid insurance, prepaid rent, any prepaid services you're buying, any kind of prepaid. Supplies is a prepaid account. We don't call it a prepaid account, but supplies is we purchase stuff ahead of time and then use it up later. So prepaid account, that's where you purchase something now to be the expense is not recorded now because we haven't incurred the expense yet. Supplies, of course, prepaid here, as he said. Equipment accounts, these are long-term assets. Building, also long-term assets. Land is long-term assets. Equipment and buildings would be depreciated, and we'll talk about that in another chapter. Land is never depreciated. It doesn't go away. Liability accounts almost will always have the word payable in them. Sometimes I've seen places where they say accrued payroll or accrued utilities or something like that. When you see the accrual in front of it, it is probably a payable as well. So notes payable, accounts payable. Unearned revenue, even though it has the word revenue in it, unearned revenue, as we talked in class, this is money I haven't earned yet, but somebody's paid me ahead of time. So we don't record it as revenue until I actually perform the services. Here are the accrued liabilities we're talking about. Wages, taxes, interest, these are accrued liabilities. Generally, just think of interest. If I owe money to somebody that's earning interest for them, that interest is growing even though there's no transaction that's happened. Nobody's sending me an invoice saying there's interest is getting bigger. So I have to recognize that and record that, have to figure out how much interest I owe for this period and record that as an expense and as a payable. Wages payable the same way. I have to, even though the year end may end on a day when I don't do payroll. So I don't have the payroll records there to show the wages I owe. But what I do is I figure out what wages I owe and record them as a payable and as accrued wages and then as an expense. Taxes the same way. Equity accounts, common stock and dividends, revenues and expenses. You notice dividends and expenses have a negative sign in front of them. They have a balance on the left side. I guess I ought to go back up to liabilities. Right side balance, assets, left side balance, and equity, revenue, and common stock have a right side balance. Dividends have a left side balance. So credit balance for revenues and common stock, and a debit balance for dividends and expenses. Let's see. The chart of accounts. Here we go. The chart of accounts just lists all the accounts I have. Usually they're numbered. Assets always start with a 1. If you see an account number which starts with a 1, it's going to be an asset. It's going to have a debit balance, a left-sided balance. Liabilities always start with a 2. They're going to have a credit or right side balance. Equity accounts, we know that common stock and revenue will have a right side balance. Dividends and all the expenses will have a left side or debit balance. Retained earnings most of the time is going to be a credit balance. It could, if we've lost more money over the lifetime of the company than we've earned, it would go into the right side, which is a really, really, really bad sign for the company. You won't see it in this book, but it'll have a credit balance all the time in this book. Unusual to see a going concern with a credit balance and retained earnings, in my opinion. So common stock, retained earnings, and revenue, credit balance, dividends and expenses, a debit balance on the left side. We'll show you what a ledger account actually looks like, but the book uses T accounts a lot. And T accounts are a tool that all accountants use to make it easy to take notes, jot down a problem and figure it out. If you're making an entry, you're trying to analyze it, set up your T accounts, and it's much easier to figure out. Left side debit, right side credit, an account title up here again. Imagine I have a balance in cash of $100. Well, it's going to be on the left side. Nobody has to tell me that. It's an asset. If I find accounts payable, it's going to be on the right side. I just know it's going to have a credit balance. Revenue and common stock will be on the right. Expenses and dividends will be on the left. And double entry bookkeeping is the gold standard of how to do accounting. Every transaction has to be recorded in at least 2 accounts with at least 1 debit and 1 credit. You could have more or less, but the total amount of debits needs to equal the total amount credited. For example, if I have 2 debits for $100, then I need to have $100 worth of credits in the other accounts to make it work out. For example, if I purchase the first entry that every company has in the book is the company or the owner puts some money in an account for the company and gets common stock. So it's an increase to cash and an increase to common stock. Remember, cash has a debit balance, so the increases are on the left side. So we would debit the cash account for, I don't know, however much money is, say it's $10,000. And then we would credit common stock, another account, a different T account for the same amount of money. If you used cash to buy supplies, they're both assets. Assets are increased by debits, but they're decreased by credits. So we would put, if we would credit cash, we would put the $100 we spent for supplies on the credit side for cash, showing that it was decreased. For supplies, we would put it on the right side, showing that it increased. If you spent $100 for rent expense and electricity, utilities expense, those have debits. They have increases on the left, and they have decreases on the right. So we're increasing 2 expenses. We would have a T account for utilities expense increased on the left. We would have an entry in the rent expense account increase on the left, the debit side, and we'd have a credit to the cash account. So we'd have 3 T accounts. The numbers would add up. If say it was $100 of interest of rent expense and $100 of utilities expense, then the credit to cash would be $200, so it balances. This little chart is not bad to keep up with. The normal balance and the increases are always on the same side. Decreases are on the other. So assets, the normal balance and the increases on the left side, decreases on the credit side. Liabilities, normal balance and increases on the credit side. Debits or decreases. The same for equity, except for the 2 accounts over there, expenses and dividends, which we know have a debit balance with increases on the left and decreases on the right. Increases on the debit side, decreases on the credit side. You can see here assets. Left is the debit, normal balance and increase. Credits, liabilities have credit for the normal balance and increases. Common stock and revenues both have credit side for increases, and dividends and expenses have debit side for increases. And like I said several times, increases, credits to common stock and revenues increase equity. Increases to debits and dividends, which are increases to dividends and expenses, which are debits, will decrease equity. So here's a T account. You can see $30,000 over here, then $4,200, and then $1,800. On the other side, this is an investment for the company, in the company by the owner. revenue earned, collection on account receivable. On the right side, the credit side for cash, this is the decrease side. We paid supplies, we paid for equipment, we paid for rent, etc. We add them all up, and we end up with $36,100 on the left side, the debit side. We end up with $31,300 on the right side, the credit side. The difference is $4,800, and it's going to go on the side that has the most money in it. The higher amount of money will determine where the balance is. So the balance is $4,800 on the debit side. I've been skipping these little videos, but these are really good things for you to do. I would recommend that I do it. You'll notice that it says C2. This is at the end of section C2. You can also find these references in the problems at the back of the chapter, so you can find a quick study or an exercise problem and match it to this section by finding the C2 in there, and you can work those little problems as you're working through the chapter. Okay, the next little bit, super critical. Everything in first 3 chapters in this book are just, bedrock critical. So we want to learn how to record these transactions in a journal and then post them to the ledger. And I've already got some videos posted in Canvas that you can look at for those, but let's go through it right here. Journalizing a transaction. We're recording here in the general journal. For an entry that requires 2 accounts, and this most simple entry in the world requires 2 accounts. You can't have one, you got to have 2. The debits and credits have to match. And you have 6 items that are important. You have the date, you have the account that's going to be debited, and you notice the account that's being debited is way over to the left. It's pushed way over, it's just aligned way to the left in this account titles and explanations column. So cash is the account that's being debited. This is the transaction where the owner deposited $30,000 in an account for the company in exchange for common stock. So we're going to debit or increase cash. So we put the title of cash over here way to the left, and we put the $30,000 that went into the cash account in the debit column of the journal. The common stock is going to be credited. Remember, common stock is one of the equity accounts, and it's increased by credits, and the normal balance is a credit balance. So we're going to indent a good bit. We're not just going to indent a 1/4 of an inch. We're going to indent enough so that somebody glancing at this page can see that this account was intended to be credited. So we got a debit here for $30,000 to cash, a credit here for $30,000 to common stock, and then we have a description. Always have a description. The book indents the description as well. I don't. That's just my preference. The second one, you notice we don't have to do the year up here on the second entry. As long as it's on the same page, we don't have to record the year. So the first entry was on December the 1st. The second entry is on December the 2nd, where we purchased supplies for cash. Supplies, I would not indent supplies this much. I would push it way over here to the line, way over to the line. So there's no question. We bought $2,500 worth of supplies for cash, so supplies went up. Left because it's an asset, so the debit side increases an asset. We paid cash for it. Cash is also an asset, but it's going to be decreased. I paid out cash, so I'm going to record it as a credit, a reduction to cash. You notice I got the title here for supplies over to the left. I got cash, the title to cash indented, and then I have the debit to supplies over here and the debit to cash, $2,500 on each side, so it's equal. And then I put a description down here. These are 2 journal entries. 2 journal entries. I want to show you the ledger. This column we're going to deal with a little bit later. In fact, in just a minute. But here's the description of how they want you to do it. We leave this PR, the posting reference column, alone until we actually move this information to the ledger. Now in the ledger, here's what it looks like. Each account has 1 page in the ledger, we'll say. The cash account we just have this, so we can see all the things that happen in the cash account in the cash account. We can't see anything else. All we can see is the cash account.